the stock market dropped 22% in one day, and almost no one remembers it. Black Monday, October 19, 1987. The Dow Jones Industrial Average fell 508 points, or 22.6%, in a single day, the largest one-day percentage drop in U.S. history. In the minutes after the bell rang, people panicked. Phones jammed. People screamed, "Was this the next 1929 or 2008? Some thought so, but unlike those crashes, there was no major bank failure. There was no fraud. In fact, the companies that make up the Dow Jones Industrial Average actually reported higher earnings in the weeks following the crash. So what happened? Well, experts blamed portfolio insurance, an early version of algorithmic trading. And while nobody was sure exactly what these systems looked like, the hypothesis was simple. As the price of a stock dropped, portfolio insurance sold more shares, which drove the price down further, which led to even more selling, and so on, in a never-ending cycle. But why did everybody use the same strategy? To answer that question, let's look at what the markets were like back then. Back in the 80s, investors could buy stocks in two ways. First, you could work with a broker who would manually trade on your behalf. This approach was popular among retail investors who didn't know much about the market. They put their trust in the expertise of their broker, but this meant brokers had significant power over their customers' portfolios. If they wanted to place a risky trade, they could do so without asking permission. In fact, this is how Ivan Boesky became famous. He was a broker who made millions trading for his clients without telling them. It wasn't legal, but it wasn't illegal either. So when Boesky was arrested for insider trading, many brokers changed their ways. The second option for investing was to use an algorithm, which sounds complicated, but was actually quite simple. In fact, you might have done one yourself before. Let's say you want to buy stock in a company called XYZ. You start by placing an order with your broker. Now your broker has to go out into the market and find someone willing to sell you XYZ stock. This person could be another broker with a client who wants to sell, or it could be a big bank managing billions of dollars. Your broker negotiates with this other party until they agree on a price. Then they execute the transaction and confirm the trade. But there was a problem with this approach. Brokers often didn't get the best price for their clients. And if you remember, back then, brokers were incentivized to take risks because they got paid regardless of whether they made money for their clients or not. Plus, many brokers felt pressure to only take on customers that they could profit from. That's why in the 80s, some investment firms like Goldman Sachs refused to take on index fund traders, people who want to buy a little bit of every stock in the market. Index funds are the most popular type of mutual fund today. But back then, they were seen as boring. That's because the people running mutual funds made money based on how much money flowed into their fund. So if you had a fund that underperformed the market, no one would invest. At the same time, though, brokers also didn't want to lose money. So if you walked in with $1 million to invest in index funds, they would probably turn you away. For ordinary retail investors, this meant that the only way to get good prices was to learn how to trade and become an expert yourself. Of course, that's a lot to ask of the average investor. Plus, the more you traded, the more commissions you paid, which cut into your profits. So in the 80s, a new product emerged that promised to solve this problem. A product that would allow anyone to invest in the stock market for free and get the same great prices as the professionals. Portfolio insurance. It worked like this. Say you wanted to buy stock in company XYZ, you would place an order with your broker, but instead of executing the transaction immediately, your broker would feed your order into a computer program. This program would figure out what the best price was for your stock and automatically buy it for you. If the price was higher than your limit, then nothing would happen. But this meant that you could buy stock at any hour of the day without worrying about missing out on the best price. Of course, the program needed to know how much of the stock you wanted and at what price you'd be willing to buy it. These details were stored in an algo, a set of instructions that told the computer what to do. The simplest algo would just tell the computer to buy the stock at whatever price it found, but that left you vulnerable to sudden price swings. What if the price of XYZ stock plummeted from $100 to $80 in a matter of seconds? You wouldn't want your broker blindly buying up shares at a high price and losing you money. So instead, many investors used a more sophisticated algorithm. These algorithms were designed to protect you against risk by limiting your losses, and each one worked a little differently. Some would automatically sell when the price fell below a certain threshold. Others would reduce the amount of money invested proportionally to the drop in price. But they all did the same thing. When the price of a stock dropped, they sold some of their holdings to limit their losses. And this created a vicious cycle. As the price of a stock fell, portfolio insurance sold more shares, which dropped the price further, which triggered more selling, and so on. And it wasn't just individual investors who used portfolio insurance. Banks used it too. They simply wrote more complex code that aligned their interests with those of their clients. For example, one of the most popular strategies among banks was the Delta One strategy. In plain English, this strategy works like this. Imagine you're a bank that wants to protect its clients from losing money. You can do this by buying stock in every company in the S&P 500, but that would be really expensive. So instead, you buy a stock index, a synthetic version of the index that tracks the value of the underlying stocks. Then you write a put option on the index. A put option gives the holder the right to sell the index at a predetermined price. So now you have two positions that move in opposite directions. As the stock index goes up, your stock holdings go up in value, but you're obligated to sell it at the lower price specified in the put option. Meanwhile, if the stock index drops, your stock holdings drop in value, but you can sell the index for the predetermined price in the put option, limiting your losses. It's complicated, but the Delta One strategy is basically portfolio insurance for banks. And since banks manage trillions of dollars, even a tiny change in the price of an index could move the entire market. So when all these systems started selling in unison on October 19th, the market crashed. But the weirdest part is that nobody knows exactly why the selling began. One of the prevailing theories is that a trader at a large institution accidentally pressed the wrong button and triggered the sale of billions of dollars worth of stock. But we don't know for sure because back in the 80s, no one kept records of trades. After all, no one thought that Black Monday would happen again, but it turns out that it almost did. In 2010, a rogue trader at UBS accidentally triggered the sale of $4 billion worth of stocks. Thankfully, the problems were fixed in time and the crash never happened, but this near miss showed that things hadn't really changed. We still relied on computers to guide our investments, and human error could still cause chaos. In fact, even today, some hedge funds refuse to trade on Mondays for this very reason. Now, algorithms don't just drive the markets. They're an integral part of our everyday lives. And the scariest part is that we barely understand them. In fact, AI is already making predictions faster than we can think. But here's the crazy thing. AI is still not the smartest thing in the room. It's just really fast. In some domains, it makes more sense to hire a human whose intuition and experience are hard to replicate than to build an algorithm that does a decent job. In others, speed is the most important factor. That's why in finance, algorithms reign supreme. And that's not going to change anytime soon. But as more and more decision-making gets delegated to machines, we need to be aware of the potential risks. We have to ask questions like, how are these systems designed and who is responsible if something goes wrong? Because unlike in 1987, today, the consequences could be much worse. For example, 80% of US stock trading volume is conducted by algorithms. And that means that if they all misfire at once, we could see the collapse of the global financial system, which could lead to, well, you can imagine the rest. But hey, hopefully it won't happen anytime soon. So thanks for watching. See you next time.